Let me ask you about the inflation data, Bob.
Yeah.
Is there a perfect storm brewing in terms of whether it's really systemic at this point? Do you have a feeling there? And I'm talking about, I don't know, we're studying closing down another pipeline, reportedly. We already do not produce as much domestically as we did a couple of years ago. We're back to being more dependent on OPEC and Saudi Arabia. There's supply chain issues. We know the Fed's been easy for a long time. What are the main factors causing this near-term inflation we're seeing, and is it more than near-term in your view?
Joe, I actually like the way you phrased the question because there's so many one-offs and different things going on. But when you go right to the core, what is inflation about? It's about prices rising for producers of goods, and it's about stress or tension or higher costs in the labor market. And, you know, we're seeing both of those clearly. If you look at the PPI today and look at it over the last, a 12-month average, then producer price index for final goods is up 12% year on year, and for intermediate goods is up close to 20% year on year. So there are some real increases here, and I think we can explain some of them away, as you said, with supply shocks. But there's some sustainable things here, like China is no longer the engine of growth that it was, or producing the cheap goods that it was on the market, which was kind of a counter-inflationary force at the time. So kind of my view, Joe, is that it is real. I think the Fed was looking for some inflation. I think if it came at 2 and 2.5% in that range, I think the Fed would be pretty happy. But my sense is this is likely going to be, as we look out over the next year, 3% or higher.
So Bob, when you were a risk manager, and we've known each other for a long time. We spent. It's like being in a foxhole at that tournament, isn't it? The AT&T Pebble Beach.
It's like, a good foxhole.
I guess it's a good foxhole, but and I'm joking. Obviously, I would never compare that, but it with the crowds and everything else, it's very daunting. The whole thing. So I know how you feel. You always were a risk manager. That's what you. Yeah. That's all you ever thought about was risk. What's risky? What scares you right now about the whole dynamic of where the market is, crypto, NFTs, art, you name it, bonds?
Yeah, I think where I get some comfort in that background that you're laying out is that although growth was down pretty significantly in the third quarter, it was from something like 6.5 or 6.7% to 2%, the lowest quarter since the pandemic began. But on the other hand, the balance sheets of both consumers and businesses have never been stronger. Fiscal and monetary easing is slowing down, but it's not like harsh, and it's not disappearing. Demand is still reasonably high. So I feel that we can transition into lower growth than we've seen during the core of the pandemic, but maybe kind of in the 2 to 3% area.
So this is a secular bull market in financial, let's talk equities, that we're in the middle of, that lasts multi-years from here, or are we in the waning stages of what's been a long bull already? And does it last forever? Does technology give us the right to continue to flourish? Do you think? Maybe it does.
Well, you hit, to me, the single most important ingredient in how long this is going to go is just what you said, technology, and the future of technology, and the impact technology has to be a kind of a counterforce in terms of inflationary pressures. So, I think that's correct.
That's we'll see whether that sounds like it's like there's no more business cycles and it's different this time, which then I get a little bit nervous.
I think you're absolutely right. The cycle has been long. It's really been going on since the financial crisis in 2008 and 2009. So I think you bring up a very important point. And I think the other thing that's happening is, with the tapering starting, I think the markets are expecting actual rate increases as early as next summer. Now, I know the Fed has said they're off quite a while, but I think the markets are saying that rate rises will probably be coming by the middle of next year. And I actually think the markets are right in that respect. So, there's some positives from that. I think we're going to get back to a more normal yield curve. I think we're going to get back to more normalized interest rates. And broadly speaking, for financial services, I think that will be a positive. So I do think. Go ahead. Sorry.
I was just going to say, what's the best way to raise taxes if this social spending bill goes through? Is there a good way to do it? Does it concern you?
I think what concerns me is kind of the emotion and the partisan, and like every other day, somebody's throwing some more spaghetti against the wall in terms of let's do this tax bill or let's do this tax bill. I think we need responsible, thoughtful tax policy, and that's not what I'm seeing right now, Joe.